New York burned because fire departments didn't exist yet, and that's exactly why they had to. July 19, 1845. Lower Manhattan, a fire started in a warehouse on the East River. Merchant ships lined the docks. Wooden buildings crowded the streets. The fire spread faster than anyone had anticipated because there was no coordinated response, no unified system to fight it. What followed was the largest urban fire in American history to that point. Hundreds of buildings destroyed, entire blocks erased. The economic loss was catastrophic. The conventional story is straightforward. The fire was so devastating that New York realized it needed professional firefighters. So the city built fire departments, problem solved, progress achieved. This narrative has been repeated in history books for nearly 2 centuries. It's clean, it's logical, it's also incomplete. Before 1845, fire response in New York relied entirely on volunteer brigades. These were social organizations, part fraternity, part militia. Men paid membership dues, they gathered at firehouses. When alarms sounded, they raced to the scene in fierce competition with other brigades. The fastest brigade got the prestige. The insurance companies paid them bonuses for successful extinguishment. But there was a problem embedded in this system. Insurance companies were betting against each other. A fire at a merchant's warehouse meant competing insurers would fight to determine liability. More importantly, volunteers had no obligation to protect uninsured properties. If your building wasn't covered, the brigades had no financial incentive to save it. The Great Fire of 1845 exposed this fracture. As flames consumed block after block, volunteer brigades fought not just the fire but each other for payment authority. Insurance companies disputed claims. Some properties burned because no brigade saw financial return in saving them. The city watched its wealthiest district turn to ash while the system designed to protect it collapsed. Here's where the conventional story begins to crack. The city didn't create professional fire departments simply because the fire was big. It created them because the fire revealed a broken incentive structure. Volunteer brigades worked when individual insurance companies could profit from them, but during a citywide catastrophe, that system evaporated. The real story is about risk pooling. Before 1845, fire insurance was a private, competitive arrangement. Each company protected its own interests. They hired brigades, they paid bonuses, they denied claims. The system worked fine for isolated fires affecting a few properties. It catastrophically failed during systemic risk when an entire neighborhood burned simultaneously. After the fire, New York faced a choice. Continue the volunteer system and accept that major fires would remain uncontrolled, or create a public service funded by taxes operating without profit motive. The city chose the latter. In 1853, the New York Fire Department was established as a professional, publicly funded organization. But here's what makes this economically significant. The fire department wasn't created because the market failed. It was created because insurance companies realized they faced a collective problem that individual competition couldn't solve. A single insurer couldn't afford to fight a citywide blaze alone. No single company could manage systemic risk. The insurance industry pooled their interests and lobbied for public fire protection. They essentially outsourced catastrophe management to government. Why? Because it was cheaper. A single municipal department operating at scale cost less than dozens of competing volunteer brigades. The math was simple: shared risk meant shared cost. This model became the template for modern insurance. When individual risk is manageable, competition works. When systemic risk emerges, pooling becomes necessary. The public fire department wasn't a triumph of altruism. It was a triumph of mutual self-interest recognized at scale. Insurance companies today still operate on this principle. They compete fiercely in normal conditions, but they cooperate on catastrophic events. Reinsurance pools, disaster bonds, government backstops for hurricanes and floods. These mechanisms exist because the 1845 fire taught the industry that individual companies can't manage systemic shocks. The fire itself was a disaster. The response was economically rational. What emerged was neither pure market nor pure government. It was a hybrid. Private companies recognized they needed public infrastructure. They paid taxes for it, and in return they received stable conditions to operate within. This pattern repeats throughout financial history. The 1906 San Francisco earthquake forced similar restructuring of insurance markets. The 2008 financial crisis exposed systemic risk in banking and triggered regulatory reform. The COVID-19 pandemic revealed fragility in supply chain insurance. Each time the mechanism is identical, individual competition breaks under systemic stress. Understanding this history matters because it reveals how modern insurance actually works. It's not charity, it's not pure profit-seeking, it's a calculated recognition that some risks can't be managed individually. They must be shared. The fire department was the first formal acknowledgement of that principle. The 1845 fire didn't create fire departments out of necessity, it created them out of economic logic. When the private system proved inadequate, a public system emerged, not because people were altruistic, because the math worked. Shared infrastructure was cheaper than duplicated effort. This is how consumer economics actually functions. risk pooling, shared costs, systemic solutions replacing individual ones. The fire department is just the oldest, clearest example, but the principle governs everything from homeowners insurance to bank deposit guarantees to pandemic relief programs. Once you understand this framework, you see it everywhere. Insurance companies aren't betting against you. They're betting that enough people will pool resources so that individual catastrophes become manageable. That system only works if the catastrophes remain distributed. When they concentrate, when everyone needs help at once, the entire structure shifts. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe so you don't miss the next unsolved case in consumer economics and financial history. This video is for educational and informational purposes only and is not financial advice. Always do your own research.